We all here? Sorry, we got chatting and but Nick Singleton here. He's going to talk to us about venture capital. He's the one that helped out with the student run fund that we started up recently here at the university. So here to talk about that program a little bit as well, but give us a look into the venture capital world. We can think about private equity being very similar. So we kind of lump those together in terms of our topic, in terms of our modules. But hopefully you have lots of questions. He's got all kinds of good stories to tell, I'm sure. And I'll just turn the time over to Nick and get out of the way.
Ryan just invited me because he wanted the guy that had the same head as him today. Yeah, so like Ryan said, I'm Nick Singleton. I am vice president at Ventura Capital. We're technically located here in Logan. We're partnered with Adams Wealth Management that's here in town. So what we do, like Ryan said, is a venture capital fund. So we invest in early stage companies. Most of the companies we invest in have been around for about a year or 2 years, doing a little bit of revenue and capital, have kind of proven their product or concept. We come in, we give them an infusion of capital, and then we help them grow. So the majority of our companies are in the technology space. So we have a few that service the property management industry, a few SaaS companies, and a few fintech companies. So to date, software as a service. So think anything that is a software that a business would use, you know, as a vendor. So to date, we've invested in 11 companies across our portfolio. Just recently had our first exit. Our fund is relatively new to this space. We've been around for about 4 years. Most funds life cycle is about 8 years. So they raise capital from investors in year one, spend about 1.5 to 2 years deploying that capital, and then the next 5 to 6 years letting that capital mature, and then companies will exit anywhere between year 4 and year 8. So we spend, while we're maturing that fund, we go out and raise a second fund and a third fund, and they work kind of simultaneously with each other. So what I do with Old Main, what we've created, is basically a condensed version of what we do at AIM. So we took a fund, built it similarly, just on a smaller scale. So we currently have 8 students serving internships with Old Main, and they go through basically the experience of what a first year and second year analyst would do at a venture capital fund. So they go out and they find deals, they perform the due diligence on that, and then they present it to a board of advisors made up of the investors in the fund. So my background is, prior to getting into VC, I spent about 2013. So coming up on 10 years now. It looks very different up here. You guys should appreciate the classroom you're sitting in. When I was up here, this did not exist, this half of the building. We had classes all over campus. Ryan and I were talking about some of the old, was it engineering building? We had old chalkboards in. I had classes in the library, the Hyper, everywhere. So appreciate.
Class in Hyper that had a dance class right behind it going. They play the same song over and over again, and it made me want to kill my students.
He did a few of, most of them survived. He only killed a few of them, I think. So right after graduation, I joined a small investment bank in Salt Lake and spent about 5.5 years there, mostly doing sell-side M&A work. What sell-side M&A work is basically representing deals, companies being sold to private equity groups or other strategic buyers. So my job was to basically document the company, write a memorandum on it, and then go out and solicit buyers on it. So I was developing relationships with private equity buyers and things like that. And then I would manage a data room and manage the process. You know, in private equity, it typically takes 90 to 120 days to complete a transaction. So I would manage all the working parts of that. From there, I spent about a year up in Seattle, Washington with another investment bank, and then came back to Utah end of 2019 and joined AIM at that time.
Same thing at these second investment bank?
It was a little bit bigger. We were a little bit higher middle market stuff, but same role, just a bigger firm.
Yeah.
So, and then made the transition to the buy side 3 years ago. And that's not a super unique transition. A lot of kids come out of school, They go into IB, they spend I probably spent longer than the traditional person would. Spend a couple years doing that. A lot of kids will go back to B school and then go on to private equity or VC from there. So I think I have the greatest job in the world because I get to meet crazy entrepreneurs every day. So I look at probably on average anywhere from 800 to 1,000 deals in a year. And we say yes to only a handful of those. So the most difficult part of my job is deciding which ones are going to make us the most money. So I was sent 3 deals just in the last day. And I got to decide, are these worth our time to pursue? And about 60% of those I can decipher in the first 3 sentences if it's going to be something that's good or not for us. And most funds have a kind of a defined investment thesis. Our defined investment thesis is something that's already revenue generating, has a technology component to it, and is located somewhere in the Intermountain states, and is something that has a scalable product. Our funds that we raise from investors has a shot clock on it, basically. We have to deploy that capital as quickly as we can and get a return on it for our investors. Because it's not like a public equity that we can just trade at any time. That capital is locked up and it's not liquid for the amount of our fund cycle. So an investor gives me money and they might not see any of it for 4 years or 5 years, or even get the return on their capital for 8 years. So we have to be smart and timely with the capital that we invest. So, but the most enjoyable part of my job is getting to meet innovators and entrepreneurs and see the unique way that people look at life and solve solutions for life's problems, or more cost-effective way to do things. Least favorite part of my job is probably dealing with auditors. Is there any accounting students in here?
Sure.
If you're an accounting student, don't go into auditing if you don't want to be not liked by anybody. So we have to go through, SEC regulations and FINRA regulations. So, which means I have to deal with answering questions that can be obnoxious at times with auditors. And so that's probably my least favorite part. Another thing I probably love about my job is every day looks a little bit different. Today I spent the morning talking actually to another investor that's looking at co-investing in one of our deals. I talked to one of our CEOs of our company. They're working on a new product line and he wanted to pick my brain about that. So not only do we offer our portfolio companies our capital and our investment, but we offer them our experience and things that we see, because we work with multiple companies, we see multiple companies. So we give them a different perspective. We're not in the weeds every day working on the things that they're working on, but we know enough about their business to know what's going on. So called me and wanted to ask me about how to market a new product line. And so a lot of my time is spent looking for new deals and talking to entrepreneurs.
Where do you look?
I source them from a number of different sources. So I have an online presence, 4 or 5 different sources simply online. One of them being PitchBook, that entrepreneurs will find me on there and just send me a cold deal. One called Axial Market, one called Signal, and one called Crunchbase, that I have profiles built on there targeted towards entrepreneurs to reach out to me if their company fits in our investment thesis. My best deals come through my personal network, whether that be from an accountant, a lawyer, another entrepreneur, a handful of local networking groups that I'm a part of. So I get deals from a wide variety of places. I occasionally will see a deal on LinkedIn that I like and reach out to an entrepreneur directly.
What kind of networking organizations are you part of?
So I'm a part of currently about 4 different ones, and they're mostly business networking catered towards entrepreneurs and business leaders, mostly in the Salt Lake area. So I live in Salt Lake. I come up to my office about once a week, along with working with Old Man once a week. So I probably, on average, go to 5 to 7 networking events per month. So it can be fun. It can be exhausting.
Like, name one of them. What's one of the organizations?
So the best one that I get the biggest benefit is a nonprofit called venturecapital.org. And so what they do is they provide kind of a format for young entrepreneurs to get some kind of coaching, and then they do pitch events. So I kind of participate a couple different ways with them. I judge pitch competitions. So think Shark Tank, just on a much more less sophisticated, more boring scale. So a company will get up there, they'll spend 10 minutes in the pitch of the company, and then me and a couple other investors will ask them questions for 15 or 20 minutes. So they just provide both, the coaching along with a network opportunity for me to meet entrepreneurs. Another one is called ACG, Association of Corporate Growth. So that is just a bunch of people, professionals in accounting, insurance, legal. And so those guys are kind of vendors that are working with early stage companies. So I get introductions. I have a really good buddy that's an insurance agent that insures 90% of startup companies in Utah. So anytime he has a client that's fundraising, he'll call me and send me a deal. So that's probably the thing I wish I would have learned earlier in my career. I started to do it, 3 to 4 years into my investment banking career was networking and building relationships. And it's benefited me in more than one way, not only for deal flow, but also in my career. I've had 3 jobs now since I graduated from here. Only one of them came through a traditional application process. The other 2 have come through networking relationships. And so I think that is something I would encourage, if I was giving one piece of advice, is learn how to network. And there's not any one set way to do it. For me, I do it a little bit different. I try and do it between professional and personal. Everybody I connect with that is going to be a beneficial relationship to me, I try and remember one personal thing about them. Like I remember Ryan likes a really bad soccer team in England, and I've never forgotten that. I had his class 11 years ago, and 10 years later, we hadn't seen each other. And I still remember that he liked that wicked soccer team.
And I'm still a fan.
He's still loyal. He claims he's loyal. I don't think he was that early. So that's something that I do personally, and it's helped me remember things about people, and it's continued to benefit me. I can now pick up the phone and call a friend and say, hey, help me find this deal, or I'm looking at this deal, give me your advice on it, or our company's raising, will you take a look at it? So that's something that I believe is my probably biggest skill set, is continuing to build my network, build important relationships. As far as skills you need as a VC, I said a few minutes ago, I look at hundreds of deals and I say yes to very few of them. So the most difficult part of my job is saying no to a founder that's poured everything into their business, thinks they have the next Facebook or Google, and I got to tell them, no, it's not good enough. That's difficult for me. But it also is, I have to do that because I have to do what's best by my investors, so I have to be a little bit cutthroat at times and very calculated in the way we measure and look at these businesses in deciphering if it's going to be a good bet or not. And we're not always perfect at that. The reason funds exist and the reason we do 11 investments is because historically, even the greatest funds in the world, 1 or 2 or 3 of those companies are going to fail and we're not going to make any money on it. So our wins have to be greater than our losses. I think you raised your hand. It depends on the investment. So it depends on where they're at. If they're in the middle of their fundraising process for a lot of businesses can take months at a time. They get a deck together and then they distribute that deck, and then they have that window open for 3 months, maybe on average, some of them. And in VC, you're typically having multiple investors come in at once. So I'm going to invest alongside 3 or 4 other VC funds each time I invest. So I might commit to my portion of capital early on, but I got to wait for the remaining amount to get committed, or I might come on at the end of it. So that's also a difficult part of what I have to deal with is telling them yes or no, or And we kind of go through phases where I get an initial introduction to them. Usually that starts with a 20-page deck that talks about their business. And then from there, if I like it, I'm going to go through due diligence. I'm going to look at the market size. I'm going to look at exit opportunities. It might be a great business, but if nobody's going to buy it 5 years down the road, it's worthless to me. If they want to hold on to the business for the next 20 years, it's not an investment for me. So it's got to check, call it 8 out of 10 boxes for it to fit into a potential investment for us. If it fits those 8 or 10, then I got to continue to do my due diligence on it. And we build out a due diligence profile, see if it's a good exit opportunity for it, see if there is market, look really deep at the competitors. And then the hardest part of our due diligence is looking at a founding team. You know, you get an entrepreneur that has this great idea, but half of them are insane, to lack of a better term. So doing due diligence on if this is a viable management team or a viable founder is difficult for us. There's no perfect way to do that. And we miss on that at times too. So, that answer your question? Yeah. What else?
How would you say your work-life balance has shifted from when you did IB to now?
That's a really good question. It is, I wouldn't say I work less, but I get to work a lot more on my time. So I work from home a lot. I mentioned I do a lot of networking events. So I work for a small group. We're a small fund inside of a wealth management group. So we have a unique structure that you don't see at a lot of VC funds. So I'm lucky in that I don't have anybody micromanaging me. My banking career, I had 2 micromanaging MDs that I worked for. So I worked really long hours and was constantly in an office. Now I have the autonomy where I can work wherever I want. You know, whether that's on vacation, at my home, or at my office. So I probably work more hours now, but my work-life balance feels significantly better. Because whether I'm doing it at 2 p.m. in the afternoon or 9 p.m. on a Wednesday night, it doesn't really matter as long as it gets done. So that's not industry standards across VC. For first and second year analysts, you're probably going to put in a lot of hours, whether that's IB or VC. But there is trends in the industry that have gone towards more work-life balance. You know, you saw 10 years ago that they were burning out IB analysts and VC analysts. So and COVID kind of helped that expedite that the work-life balance is getting better.
Earlier you said maybe like 3 deals a day. You said 1,000 deals over a year. That's not necessarily 3 a day. So is
some of them can, you know, come in waves. And when I say 1,000 a year, it might be.
I'm gonna say, yeah, is it a day of 10? And
so when I say 1,000, that's 1,000 deals that somebody's asked me about. Maybe I go to a networking event and I see 25 deals in one day.
Yeah.
But actually looking at deals, that number is probably closer to 400. That I see the deck and at least look at part of the deck.
And then how many do you do a deep dive on them? Like what, I'm just thinking of the funnel. You go from 1,000 down to 400, down to what?
A deep dive in a year would probably be 80 to 100 of those 400.
Okay. And
Is
then
what we
that
do.
ends up in 11 investments over a couple of years.
11 investments over about
Maybe
a
6.
year and a half.
Okay.
Yeah, so you call it a deep dive, probably 5% is what we end up investing in after we deep dive them. And sometimes, depending on the source of the deal, I will do a deeper dive or a phone call just for my relationship. You know, if I get a cold deal and I have no connection to them, I might not even respond to the email because I just get an abundance of them. But if one of my portfolio company has a entrepreneur that they're connected with and they send me the deal, 10 times out of 10, I'm going to take a phone call with them. Even if I know right away it's not a deal for me. Again, that's part of just maintaining the relationship side of things and the network side of things.
So how does a first or second year analyst job day in the life compare to what you would be doing? Because clearly you're not mapped to that role.
I actually kind of serve that role. I wear a couple hats because my fund is small. But if you were at a bigger fund, typically first and second year analysts are sourcing deals. You know, they're sourcing deals. They're doing that initial deal screen. They're probably spending 30 minutes to an hour talking to an entrepreneur, And then they're going to build out kind of the due diligence on that. And that, includes a financial model that they're going to break down. They're going to look at the market of it, and then they're going to kind of take that up the ladder, take it to an MD and say, I like this. If it goes from there, there's usually an investment committee that deals are presented to. Investment committee votes on whether they go forward, and the decisions are made there. So the initial introduction to a deal typically comes through a first or second year analyst at most funds, though. Let's go here first, then. Yeah.
So are you part of the process of exiting the deal?
It depends on the deal. So this deal we just recently exited a few weeks ago. They hired an investment banker to help them exit the deal. So we supported them. We have a board position with them. So we supported them from that role. It wasn't a lot of heavy lifting for us. It was just like, hey, these are the options on the table. We helped them review the term sheets, and we encouraged them what options were the best and kind of gave them a thicker outline on those options. But the banker did most of the lifting on that one. Depending on the deal, though, we will get more involved in it. Some of our smaller ones that have looked at exited, we've been a little bit more involved in walking them through the process of exiting, helping them come up with a prospective buyer list on it.
About that. What kind of made you decide?
It's
like 5 to 8 year time frame.
It's kind of a collective decision between the current cap table. Like I mentioned earlier, we usually invest with other investors, and then there's other parties that have equity in these businesses. Typically, the founder is going to still have a big portion of the business. So it's going to be kind of a collective decision is now the right time for us. And we try to time it as a group of when are the best market conditions for that particular company. The market overall is kind of in a low right now, but for our one particular company, they had benefited from a low in the market. So now was the best time for them to exit. A few of our other companies,
They went public or they got bought?
they got bought by a public company. So it's just the timing of the market. Again, we don't time it perfectly, but we try to. And a part of our due diligence process is getting on board with a founder or a founding team of when their desired exit is. And if that comes in that 6-year window, great. If it's 10 to 12 years down the road, we're not even going to invest in it. That answer your question?
Yeah, so I know you mentioned it might not be the case at every VC fund, but at least in yours, what % of your portfolio or your deals are ones you're sourcing versus ones where entrepreneurs come to kind of pitch?
So we don't have one in our portfolio that was what I'd call a cold deal. The majority of them came through a mutual contact. Whether that was a handful of them came from our founder's former career. He had been with Conservice here locally. He was their CFO, and they had worked with a couple of the other companies in the industry. And so he had those relationships. When they found out he raised the initial fund, they came to him and said, we're raising money. That made up probably 30% of our fund. And then the remaining 70% was through mutual contacts. One of it was an attorney. 2 of them were from other entrepreneurs that we knew. So it's unlikely, and most funds are this way, that they invest in a cold deal. If I get just a random email from Joe in Toronto that says, I got this company, unless it's a really good company and jumps off the page, probably not going to invest in it.
I don't mean like make it sound bad, but doesn't that seem kind of like bias?
It's absolutely biased, but purely based off the volume of deals we see, we kind of have to have some kind of criteria for that. And most of the deals I get cold aren't very good anyways. And I know that, because they're not, and I can tell from their email. If there is cold ones that are good, but they've researched my fund, they've researched me, and they say it in the first 3 sentences of the email. But if I know they're sending a generic email, I got one the other day that said Nick, comma, last name. Like they'd only gotten my first name and they were simply doing a blast email and forgot my last name to put into it. So I know that they haven't done their homework on it and they're just blasting the email out to as many people as they can without running any kind of process. So it sounds more probably biased than it is, but we have to have some kind of criteria for that.
So you said that like within the first 3 sentences, you can usually tell like 60% of the time whether you're going to continue. What are like big red flags? I know you just mentioned like you can tell it's like a blast email, but are there any other?
Okay, for example, I got one a few months back that said in the first 2 sentences, we're taking down both Facebook and Amazon in the next 5 years. That's just dumb. I know they're not going to do that. And I know based off of that, I can know that their decision making is poor. So that's a red flag for me. Or if they say I'm raising money for a food franchise, I'm not going to invest in anything in the food space, you know? So I can tell off of the product and industry real quick if it's going to be something that fits us. But there is different investors that it might fit. That's just for us and our investment thesis.
So what kind of things make a deal look more attractive or that you would be willing to put capital into then?
So I kind of said a few things earlier. It's got to be doing for us $1 million to $2 million of revenue in a year. It's got to be a recurring revenue model, which means somebody, either a business or a consumer, is paying some type of subscription. 3, it has to be scalable, which means that eliminates a lot of physical businesses, you know, like manufacturing, we're not going to touch. Most consumer, we're not going to touch because those businesses are hard to scale because they come with a lot of capital needs. And then the industry, there's a few industries that we like more than other ones. Property technology is our favorite industry because we've invested heavily in that space and we understand the space well, and we understand what works and doesn't work. So if you're in that industry alone, you kind of have a leg up. But then there's, like I said, fintech and SaaS as well. So the biggest things for us is the revenue model, the industry, and the scalability of it. Somebody else?
So I know I've read a lot of things these last couple of years. Utah's like one of the highest for unicorn startups and things like that.
Yes.
Could you speak a little bit on that and then just kind of the opportunity that presents for your fund in particular?
Yeah, I can't remember what it is. Somebody posted an article recently, but we, per capita, we're by far the highest unicorn companies. And what a unicorn company is basically a startup company that grows to an enterprise value of $1 billion. Probably, this is my opinion for the reason that is because we have a very strong entrepreneurship community, you know, and that starts at the university level. You know, here, BYU, Utah, and some of the other smaller schools are very strong and encouraging, you know, rather than going out and finding a job, create a job. And then secondary to that is we have a good investment community that supports those entrepreneurs, that takes a chance on young entrepreneurs. There's certain funds that want to see, you know, an old sophisticated founder that's been there, done that. I think Utah's a little unusual in that we're willing to bank on first-time entrepreneurs, and those gambles have paid off for a lot of groups. And Utah in general is an easy place to do business. You know, I spent a lot of time on the road when I was an investment banker meeting with private equity groups all over the country. And our joke at my iBank was, you can have a business idea in Utah at breakfast and a full-fledged corporate docs by lunchtime, and you really can almost do that. I met a private equity group a few years ago at a conference that had, they owned a couple breweries. They owned one in Utah and one in California. In Utah, it took them 4 hours to get a permit to build new tanks. In California, it took that same permit 4 months. So Utah's economic and government is very pro-business, that it makes it easier in a lot of ways to become a unicorn because you're not dealing with as much red tape and regulations, you know. And there has been, you know, different departments like the Utah Office of Economic Development that has given grants to young entrepreneurs, help them grow. So there's multiple factors, in my opinion, as the reason that we see unicorns continue to be born out of Utah And now you're seeing big companies relocating to Utah or expanding to Utah. You know, Adobe now has a campus in Utah, Facebook's built in Utah, and others are coming, which means the talent level of Utah continues to grow. You know, so maybe there's, and I mentioned Adobe. I got pitched by an entrepreneur that had been a software developer at Adobe. So all of Utah Rising continues to grow the talent pool as well too.
Can you kind of walk us through like just one of your, I don't know if you can disclose the company and just kind of tell us, okay, how did it come to you? Just kind of walk us through the process for one specific company and what that looked like and how they're doing and how you check up on them, or just give us kind of a case study version of one of your investments.
Yeah, so one of our investments we did the initial investment right when I was joining the fund, end of 2019, beginning of 2020. It's called Gab Wireless. So what Gab Wireless is a child cell phone. So it looks just like this, but it is specifically for children. So it doesn't have an app store. It doesn't have the internet on it. So it means children don't have access to the internet, the app store, or anything like that. So it's safe technology for kids. So the introduction came through an entrepreneur that my boss was connected to. He says, "This is a great deal. I know these founders. Come look at it." Lined up a meeting. We went, we sat through an initial pitch. This company was very early on at the time. They had about 5,000 users across the company, and which meant they were doing about less than $500,000 in revenue. So we did an initial investment, a small check prior to their seed round. And the way the investment timeline kind of works is most entrepreneurs will kind of bootstrap things. Bootstrapping means you just kind of use your own capital to fund it. Sometimes they'll do an angel round or a friend and family that they'll go ask their parents for $10,000, $5,000 to invest. And then from there, there's a seed round. Seed rounds usually occur once you've got a little revenue to you and you've kind of proved your concept. That's typically where we invest. And seed rounds can be anywhere from $3 million round up to a $5 million round. And then from there, it goes Series A, Series B, and beyond that. So we invested prior to their seed round, which was unusual for us to do, but we wrote a small check into them. And then we led their seed round. And leading means that we wrote the biggest check, we dictated the terms of the deal, and then other co-investors came in and wrote checks on the same terms that we did. And 3 million. And we did the majority of that. And then other investors came alongside of us at the same term. So that seed round occurred spring of 2020. And then at that time, my boss stepped in as their interim CFO. They weren't big enough at the time to go out and hire a full-fledged CFO. He spent 16 years as a corporate CFO. So stepped in to help them kind of get their banking and finances in order. And so helped them build out their executive team as well. Did that, he's continuing to do that today, but fast forward a year after that initial investment in spring of 2021, company continues to grow, more users are added to it, more products are developed, a watch product was developed, a music app was developed for the phones, and we decided to up our investment. And so we participated in the Series A round, but we did not lead that investment. There was another investor out of Utah County that led that, but we participated in that as well. And we didn't just invest in it because we'd been prior investors in that. We kind of had to look at the deal like it was fresh to us, because there is some stigma that comes and some pushback from investors if you're just investing in something because you've been there. They call it chasing bad money with good money, that we're just putting money in to save our investment. We can't do that. We shouldn't do that, but it does happen with investors a lot. So we had to reevaluate the business a year and a half. Obviously, we were a little bit more intimately involved with it. It was easier for us to reevaluate it. And so we put more money into it. Fast forward another 9 months, and they were raising a bridge round. A bridge round basically is just kind of a middle round. It's not an A round, it's not a seed round, it's not a B round. It comes in between. So this was a bridge round between there. It's smaller, and it usually has a different structure to it. It doesn't usually have there's different ways that rounds are priced. Sometimes a seed round may be priced with a convertible note, which means you're basically investing debt on certain terms that say, my debt will convert if you haven't paid it off in a year, and I'm going to collect 6% interest on it, and it's going to convert at a $20 million valuation. A price round means I'm investing in your company and it's worth $30 million. A bridge round typically doesn't have a price to it. You usually do it as a safe or a convertible note, and you say, we'll price it off of the upcoming round with some kind of discount. So you put money into that, knowing down the road you get a 20% discount that the investors that come in at the B round don't get. So we invested in that just this past kind of springtime, and now the company is getting ready to raise a formal B round. So we invested in the company. 2020, they were doing $500,000 in revenue. This year, they'll end the year with about $75 million in revenue and about 300,000 users. So the investment is growing really well for us, and we continue to be bullish on that. Now we're looking kind of forward to what are the exit opportunities for this. We're still not there yet. We still feel like there's a lot of growth for us before we get to that exit, whether that means, 400 million in revenue or 250 million in revenue. But Greg, who is my boss, sits on that board and kind of works with the executive team there to kind of etch out the roadmap going forward.
So how much did they raise over that several rounds? Just ballpark.
35 to 40 million.
And then how would they, you said 75 million in revenue this year. How do they, in VC, how are you going to value that? You can use the multiple off of that, or are you going to, obviously it depends on the type of firm. But
Yes.
for them, what would you have said would be a good way to?
It's typically revenue multiples. So that's where PE and VC differ a lot. Private equity, you do a multiple of EBITDA. EBITDA is your earnings after interest, depreciation, and amortization. But in VC, most of our companies are not cash flow positive, so we apply a revenue multiple to it. And revenue multiples are based off of the industry and size typically. So businesses that aren't super capital intensive will get higher multiples. So SaaS companies can see anywhere from 10 to 12 times their revenue. Consumer products are probably closer to 4 to 5x. Gab is kind of in the middle ground there. Has a tech component to it, but it also is a consumer product company that comes with capital requirements. So it's probably more likely to be a multiple of, more in line with a consumer product. Probably 4 or 5.
4 or 5.
Yeah.
And then, did you do anything at the beginning when you were evaluating them for your, like in the seed round? Are you doing? It's much harder. Like they don't have.
Seed rounds are hard because if they don't have much traction, a 4 multiple of $500,000 is very small. So when it comes to earlier stage rounds, you have to do a lot of forward projecting. So it's like we predict that by the end of 2020, your revenue's this. We apply the multiple to that.
Do you remember how much did you value them at?
The seed round.
Or in early days.
15 million. Yeah. So that investment for us is growing significantly. But again, our gains are on paper at this time. It could go down, and you've seen plenty of companies. There's been a big one in the news, FTX, which was a crypto exchange. 30 days ago was worth $30 billion, and today it's worth 0. So just because something is valuable today doesn't mean it's going to maintain that value in the future. So for us, we have to be calculated in what we show our investors that, yes, this is a paper gain. So we don't write our investments up for our investors unless there's some kind of qualifying event and that another investor is quantifying the value of it. So that investment.
Yeah, so the next round, all of a sudden it's re-pegged in terms of price, and so then you guys will.
So the price we hold on our books is almost 2 years old at this point because there's been no priced round available for us to reprice that. We kind of have in mind what we think it's worth, but we just can't write that up because we'll get in trouble with our auditors and we're just setting ourselves up for trouble with our investors.
Other questions? Skill wise, so you're saying you're building models, I assume that's in Excel, most of the time your financial models. Using any other software, anything specific? I mean, you have some of these online platforms that you're using, but that's pretty straightforward.
It's pretty straightforward.
Yeah, I mean, coding, you're not doing,
No.
I mean, everything's kind of one-off, so you can't write an algorithm that does this stuff because every company is so different and the network's kind of a valuable piece.
Yeah.
Talk about the importance of networking, anything else you could think of that they should think about?
Yeah, so it's communication, building a network, financial modeling, understanding different business models. You know, I get better at my job the more business models I look at. So even though I am telling many people no, it's still a way for me to look at somebody else's business model and see how they're doing anything. And can I take that idea that they're doing and help one of my portfolio companies with that? And then, you know, it's also, how do I support, you know, not only on looking at new investments and finding new investments, but how do we support our current our current portfolio, you know? And again, I kind of talked about, we try and offer them a different perspective on things and work with the executive team there. And we're lucky that we're invested in companies that are in a similar industry, but they're not competitors. So we've helped them form strong strategic partnerships so they can share customers, share ideas and things like that. So that's where we've found advantages into investing consistently in the same space. Do you have a question?
Yeah, could you touch on
Compensation varies, you know, bigger funds, you're going to get a lot bigger checks. So the way our fund makes money is it's called 2 and 20. So we charge 2% on the capital that's given to us, and then we charge 20% on everything we make over the principal. So an investor's principal amount is returned. Say they give, simple numbers, they give me $100. I charge 2% a year on that $100. So I'm going to charge $2 as my management fee. If that fund turns into $200, I'm going to charge $20 is what I'm going to keep, and they're going to get back their principal of $100 plus $80 on their return. So the reason I talk about 2 and 20 is smaller funds don't have a ton of capital for bigger compensation bigger salaries. So you take a little bit of a risk and you get more money on the back end down the road. But that means you're kind of waiting for compensation down the road. Bigger funds, you can see a first-year analyst start from anywhere from 70 to probably 90 with a bonus on top of that. But that's really sophisticated funds that, you know, you're competing with Ivy League schools to go there. You know, you're more likely in the range of probably 65 to 70 for probably a first-year analyst with a bonus on top of that. It's higher than that now? Jeez.
Inflation.
It was 40 when I was coming out of school. So yeah, it's come up a lot. Anything else?
Yeah, I had something like that. I lost my train of thought, discussion on compensation. I don't know. I forgot. I had something.
You recommend, so if you say no to somebody, you recommend them somewhere else? Or?
I try to, especially if it's come through one of my personal network. If it's a cold outreach, unless they've done their homework and really done, like I said, a genuine outreach. But if it's somebody that one of my contacts has introduced me, I'll tell them what other investors to go to, or even make an introduction to, you know, one of my contacts at another fund. And again, we are kind of competitors, but we're also colleagues in some ways too, because we like investing on deals together. Whether it's them leading or I'm leading, we benefit in doing things together rather than competing with each other in a lot of ways.
I have one more question. So in terms of certifications, or I can't think of anything specific to VC from certifications, education. I mean, on the tech side, they don't care to some extent, like when you're working with tech companies. Some other big banks and other things want business school and want CFA certification and other things. What, any advice on that end in terms of continuing education or ways to, you said kind of in your discussion that seeing different deals helps educate you on those deals and makes you better. Any other ideas in terms of how to continue to get better at it or other things that are important in the industry?
When I was a banker, on touching on licenses, I did have a couple FINRA licenses. If you don't know what FINRA is just another financial regulatory board like the SEC. So I had a series 63 and a series 82, which is specific towards the investment banking. It's basically gives you the legal right to resell private stocks is basically what it is. And then I had a Utah real estate license because Utah has a unique rule when it comes to the sale of assets. You have to be a licensed real estate agent. As far as continuing ed, what I would say, I only did an undergrad. It's pretty common that you see, and it's becoming less and less common that you see people in VC and PE have graduate level degrees. You know, I did early on in my career, I thought that's the route I would go, is I would do IB for a few years and then go back to B school, but I could never justify the rising cost of that. And so I would say for me, it was getting my feet wet and finding where my skill set was and the things I enjoyed the most, and then figuring out how to